Index funds, exchange traded funds or ETFs, and mutual funds are pivotal players among myriad investment choices today. In this video, we'll explore these investment vehicles, comparing 5 fundamental differences between their structures, benefits, and considerations to help you navigate the complex investing world. Before we start, take a pause and read this disclaimer carefully. This video is for entertainment and education only. Do your research before investing. If you don't know me, I'm Avanti. I'm a mom, an investment analyst, and a CFA charter holder. Follow me to learn how to simplify your finances and build wealth. Let's review the fundamental difference between a mutual fund, an index fund, and an ETF. Mutual funds represent a portfolio where money is pooled from investors to purchase different securities to create a diversified portfolio. If the fund manager or managers decide on the specific securities that go in and out of the portfolio, the mutual fund is said to be actively managed. The fund manager can use fundamental or technical analyses, a quantitative algorithm, or a combination of analysis techniques. Historically, all mutual funds were actively managed. The objective of an actively managed fund is to perform better than its benchmark, which is an index of securities. An index fund is a special class of mutual funds that is passively managed. The objective is to replicate the returns of an index of securities. The fund manager does not try to pick and choose different securities. Instead, the fund manager replicates the entire index or takes a sample of the index or uses derivatives to achieve synthetic replication. ETFs are similar to mutual and index funds in that they can be actively or passively managed. Passively traded ETFs are also indexed, but I will call only non-exchange traded passively managed mutual funds as index funds for this discussion. The first difference when we compare mutual funds versus index funds versus ETFs is how they are traded. Mutual and index funds can be bought and sold through the fund company at the end of the trading day at the net asset value or the NAV. You have to place your order before the end of the trading day to get that day's trading price. The deadline is typically 4 p.m., but it may be earlier in the day for some funds. The fund company determines the net asset value after the market closes by accounting for the values of all securities in the fund. Fund companies may also employ proprietary formulae to come up or develop the formulae to develop the end of day NAV to prevent arbitrage. When fund managers use a formula to adjust the end of day NAV, the adjustment is called fair market value adjustment. This adjustment confused me when I first started trading international mutual funds. So let me explain what that means. Fidelity has an international index fund, FTIHX. When I began tracking the daily return, I would see large deviations from the underlying MSCI ACWI X US IMA index day over day. Even though over the long run, the returns for the fund mimicked the returns of its benchmark. So here's what was happening. FTIHX holds stocks from different countries, including Japan, the UK, Canada, France, India, etc. When the Japanese market is closed, the Canadian market may be open. Any financial news worldwide is immediately reflected in the Canadian stock market because it's open. So you will see an immediate impact on Canadian stocks. However, Japanese stocks will not change because the Japanese market is closed. So Japanese markets won't change in price until the following trading day when the market reopens. If there were no fair market value adjustment, the end of day NAV value would reflect current Canadian stock prices but stale Japanese prices. With positive financial news, I could immediately place a buy order for shares in the fund. If there is no fair market value adjustment, the NAV will have stale, lower priced Japanese stocks so that I can buy the fund at a bargain. And then the next day, when the price of Japanese stocks goes up, when the Japanese market reopens, I could sell Japanese stocks or sell my shares in the fund, making a profit in the process. Risk-free. This process is called arbitrage, which is profiting without taking any risk. To prevent arbitrage, funds use fair market value adjustments, and only the fund knows the formula, so we can't take advantage of timing differences in different markets. Conversely, ETFs trade over the exchange, similar to stocks. You can buy and sell an ETF during a typical trading day without waiting for an end-of-day NAV. This allows some flexibility if you are into timing the market or day trading. The next difference is in the minimum investment. Often, mutual funds and index funds have minimum investment requirements. For example, several Vanguard index funds have a $3,000 minimum investment required. ETFs have no such requirement. You can buy as little as one share, and the minimum purchase is limited to the price of a single share of the ETF. Some brokerages may allow you to purchase fractional shares, in which case the share's price does not limit you. The next difference is in fees and expenses. Most actively managed mutual funds have higher fees. Some even charge front-end loads and back-end loads. You must read a mutual fund's prospectus carefully before investing. I discussed how to understand the prospectus in this video. Indexed funds, on the other hand, typically charge lower fees. Again, it depends on the type of index fund. It is a common misconception that all index funds have low fees. Index funds track indexes. If it is an index fund tracking a specialized index, the fees may be high. Index funds will give you many options where you won't have to pay hefty fees. I discussed how fees can affect performance and lower your returns in this video. Passively managed ETFs are similar to indexed funds and should have lower fees or expense ratios. The actively managed ETFs can charge high fees. The next big difference to consider is tax efficiency. Mutual funds and index funds may distribute capital gains to shareholders when the fund manager sells securities within the fund, even though you, as a shareholder, didn't make any withdrawals from the fund. This distribution leads to a taxable event every time capital gains get distributed to you, triggering a capital gains tax. Therefore, holding mutual funds in tax-advantaged account may make sense versus a brokerage account. ETFs tend to be more tax efficient. You don't incur capital gains taxes unless you sell the ETF. You must pay taxes on dividends received from the ETF, either ordinary income tax or capital gains tax, depending on whether the dividend was ordinary or qualified. I discussed stock market taxes in this video. If you missed the discussion, click the link. The next difference is automatic reinvestment. Most index funds allow systematic investment plans, enabling you to make regular contributions. Automatic investments may be available for some ETFs through the brokerage, but it may not be a feature across the board. I want to leave you with a thought. Some actively managed mutual funds may appear attractive compared to index funds or ETFs, but many factors go into determining whether they are worth the high fees they charge. Make sure to do your research before investing. Thank you for staying till the end. Feel free to ask questions in the comments, but I also like words of encouragement, kindness, and constructive criticism if you have no questions. If you enjoyed the content and found it useful, please give me a like and a follow, and that will do for now. As always, don't forget to be happy, kind, and your best self. I will see you in my next video. Bye.